Hello everyone. Today we have got a very unique topic. Usually this kind of research we can easily find it for S&P 500 or for any US stock, but luckily last week I found it for our Indian Nifty. I mean, the statistics that this research paper shows are very interesting for me. I hope you too find it interesting as well. As I always say, every bit of additional information will give us an edge to make more collective decision in the stock market. In this video, we are going to cover first what's the effect of weekday in Indian stock market, particularly in Nifty. I mean, between Monday to Friday, if we do trading, when probably we make money, when we get good returns. Second, we go a little bit wider and we see what probable returns we get if we take a trade on any given day on the given month. Finally, again little bit wider, in a given year, what's the probability of return that Nifty gives. Just I want to highlight, this is for just knowledge purpose only. Don't make trade based on this. If anyone fancy reading the whole research paper, feel free. I will attach the link in the description below. So without delay, let's start. First, when it comes to stock trading, does the day of the week really matter? Isn't it okay as long as the stock is strong and the price is right? Any day would be fine, right? But our Indian market is like a cricket match. It got full of surprises and unexpected twists. And in this game, we have some unusual players, the Monday and Wednesday effect. These effects suggest that generally returns on Monday are usually lower than other days, and the trend on Monday, it often copies what happened on the previous Friday. So if the market fell on Friday, like day before yesterday 7th July, as per the research paper, more probably the following Monday would also be down. I mean, the researchers worldwide have been studying these phenomena and they have found similar patterns in other markets as well, not just in India. Some suggest that it's not about the day but the trading hour. The first hour on Monday tends to follow the last hour on Friday. But why does this happen? There could be many reasons. Maybe Monday blues. Monday blues means people feeling low due to beginning of the week. Or it could be negative news released by the companies in the Friday after market hours. But what does this mean for our Indian market? If required, please pause it. This is the Nifty weekdays return between 1999 to 2007. Here, blue bar is the Nifty's one and the orange one is the Nifty in dollar terms. I'm guessing that dollar term Nifty they were referring to SX Nifty, but the research paper doesn't mention any of those details, so we too say dollar Nifty. Anyway, if we see the returns in both normal Nifty and dollar Nifty, Mondays have had the lowest average daily return. I mean, in Nifty terms, more probably on average, it will give the negative return. And now in contrast to that, on average, in Wednesday, we will get 0.24%, which is way higher than any other day. I mean, the next maximum returns day, surprisingly, it's Thursday, and that's too less than half of what we might get on Wednesday. As I said earlier, it could be various reasons, but this Wednesday effect is more severe in India. I think the reason for that is option expiry in Thursday. India generally a bullish market, so more often it trades premium than other emerging market and in the elevated range like the present time. So its general public financial behavior thinks that particular stock or index is in the overbought condition. So they write lot of call options in Friday and following when the tide turns on Tuesday, they run for cover on Wednesday. That unwinding of call option on Wednesday and Thursday making them more bullish compared to other days. But remember, the returns what we discuss here are averages and the whole truth isn't always visible in averages. For example, in another study, only 58% of all Mondays followed the same trend as the previous trading day. And if a Friday had negative returns, only 55% of the following Mondays also had negative returns. So if you short Nifty on a Monday following a negative Friday, we could lose money 45% of the time. Those aren't very good odds. So I don't recommend to make decision just based on these facts. Okay, now let's move to the second one, little wider. What probable returns we get if we take a trade on any given day on the given month? We know, and I see some of my friends and including me, lots of us spend most of our salaries right at the start of the month, right? Paying rent, house EMI, buying groceries. But should we do the same with our investment? Let's find out. Research says that the stock market returns are usually higher around the turn of the month. This surprising behavior is called the turn of the month effect. It was first reported in 1988 in India, and this has also been found in different markets worldwide. The turn of the month is generally the last and first 3 days of the month. And interestingly, it's found to affect in smaller stocks more as it was limited by liquidity. So what causes this effect? One theory says it's due to the higher cash flow at month end, salaries, pensions, dividends come in and people start investing. This influx of money not only comes from individual investors but also from big institutional investors like pension funds and insurance companies. Another theory believes that as the month end approaches, we get more company results and macroeconomic data. This reduces uncertainty and makes investors less nervous, resulting in higher, more stable returns. Now, how does this effect play out in the Indian market? Let's look at the Nifty's return between 1994 to 2012. If we see, the returns are usually higher around the month's beginning and end. Specifically, the last 3 days of the month averages at 0.22% return and the first 4 days was 0.29%. As if we move away from those 7 days month beginning and end, returns drop to a negative 0.004%, which is roughly flat. And if we take the first 9 days and last 8 days out, then for the middle of the month, the returns further decrease to negative 0.07%. So, is it okay if we invest around 20 to 23rd of every month? Will we get very good returns for our money? Like our favorite Indian movies, there is a twist here. This effect doesn't happen all the time, it's cyclical. I mean, if FII or DII found this means, then they all start to invest in the middle of the month rather than the start and end of the month. So, they can profitize from this effect, thus it increases the demand in the middle of the month, so does the price returns. For example, in 2004, if we had invested only on the first and last trading days of the month, we would have made 1.1% more than investing during the rest of the month. But in 2006, returns during the rest of the month were actually higher. So, what is the lesson here? Timing the market based on the turn of the month effect is tricky. It's not always a sure thing, but particularly those who invest in index fund periodically, they can adjust their investment timing, thus it might be benefit from the long run. Finally, let's look for a year. It's very important for option sellers what is the probability a normal distribution looks like. I mean, if we plot the daily returns of the Nifty index on a graph, then we will get this bell shape. In simple words, this is the Nifty's normal distribution between 2010 to 2013. This details I found it from Money Control. It means on most days, Nifty's returns are near zero and extremely high or low returns are less common. This brings us to another term, standard deviation. You can think of it like a measuring tape. It tells us how spread out the returns are. If the returns are close together, the standard deviation is low. But if the returns are more spread out, then the standard deviation is high. Now you must be wondering why we are talking about this, right? Let's get into the interesting part. With these calculations, we can say there is a 68% chance that Nifty return on any given day in a year will be between negative 1.28 and positive 1.4%. Similarly, there is a 95% chance that the return will be within 2 standard deviations, meaning between negative 2.62 to 2.74%. And 99.7% chance is within 3 standard deviation. Note this, it's not impossible but very unlikely 0.03% chance for Nifty to give daily returns higher than 4% or lower than 4%. Such rare extreme events are called Black Swan events. That's what happened in March 2020, the Black Swan event, when Nifty crashed by 13% in one day. Now, let's see how this knowledge helps our option trading. Say you are an option seller and you're okay with a 68% chance of making the profit. Then, sell options that are out of the money by more than 1 standard deviation. This will give a 68% chance that whatever the option we sold will be expiring out of the money, meaning the option seller get to keep the premium. But if you are an option buyer and you buy a strike at 1 standard deviation away from the spot, then the chance of making a profit is only 32%. But remember, for option sellers, more safety means less premium. If we want a 95% chance of profit, we will need to sell options that are out of the money by more than 2 standard deviations. But such options will have a very low premiums. It's like a balancing act between the premium you get and the chance of making a profit. Last but not least, option traders can set stop losses and target levels based on this probability knowledge as well. Instead of having the same percentage for all assets, these specific levels allow room for expected fluctuations. But remember, we are basing all of these on past data which might change in the future. So that's all in this video. I hope you all got some useful information and found it interesting. Please consider subscribing the channel and liking the video so it will help me beat the YouTube algorithm and will also motivate me to do more. Please don't make any investigation based on this as I'm not a SEBI registered advisor. I'm doing this for my and viewers' educational purpose only. Thanks for watching.